Hey everybody, it's Ken McElroy here. I'm here with my good friend Melissa Murphy. Welcome, Melissa.
Thank you, Ken.
Yep. She's got an incredible company called Prime Real Estate Group up in the Pacific Northwest. Lots of businesses, lots of employees, lots of offices, and she started in real estate investing after reading Rich Dad Poor Dad and starting with one cash flowing unit. And welcome.
Thank you.
Yeah, I'm so proud of you.
Thank you. I can say you've been a fantastic mentor over the years. I read your book before I even met you in person, have heard you on stage numerous times, and it's always a treat. So I follow everything you do.
Oh, thanks. Well, what I really love about talking to you is that you literally took action. Without really having a lot of real estate experience, you read Rich Dad Poor Dad, you went out and did it while you were in college.
Yes.
And then you ended up buying more, and you bought a 12-plex, and the rest is history.
Yes. I would say a lot of times working with my clients or those looking to invest, it's always that first deal that's so challenging. So it was really great to jump in and then navigate through the market almost a little through trial and error.
I know. And so now you have all these agents that work for you, and you've created this massive business here locally up in the Northwest. So fantastic, and congratulations.
Thank you. I appreciate it.
What we're going to talk about today are the 3 reasons to invest in submarkets versus bigger cities. Because, guys, we're seeing this now. You're watching these migration patterns. These people move out of New York. They're moving out of Seattle. They're moving out of LA. They're moving out of San Francisco. And they're coming to places like here.
Right.
And you're right in the middle of it with one of the bigger real estate companies in the area.
Absolutely. And what's so fascinating to watch is we get a lot of investors who are struggling to get a 3 cap in some of these larger markets. So what we're finding is affordability and even the opportunity to get your foot in the door and invest is opening up people's eyes to smaller markets. So one of the things I would say why that's important is because if you're going to wait 5 years to accumulate enough reserves and enough cash to get into your first property, and it's not perfect, you may not invest again.
That's a good point. So the first one is affordability. And so do you think that's the major driver here?
I think it is a very strong driver. We also have a very stable economy. We've been seeing here in the Coeur d'Alene area, we've been seeing unemployment numbers as early as last year in the 2s. So we've had a really stable market. We've had relatively favorable conditions for investing.
Yeah, you have. And you talked about cap rates or capitalization rates of being 3% in these big cities. Basically what that means is things are really expensive.
Yes,
right?
That's exactly right.
I mean, it's hard to buy. It's hard to buy in these big cities.
Right. And essentially that means your return on investment. And if you're going to take the risk and really put your money on the line for 3%, it just there has to be appreciation, which has been rather consistent in some of the large markets, but you can't always bet on that. And that's where I see people get into problems when they say, question, what's this going to be worth in 5 years? You can never ever just speculate on that. You always want to look at the cash flow. That's
a really good point. So we have affordability. Let's talk a little bit about knowledge workers and how they're viewing affordability.
Right. Well, a couple years ago, there was an economist who said the mid-sized cities was going to be the one to watch in 2020 and beyond. And it had to do with the millennials who have the mindset of they want it all now, meaning they're not going to do a 2-3 hour commute to a small apartment. They're going to want to own a home and have a cute coffee shop and really have that quality of life. And so COVID essentially accelerated that dream. So we're seeing an in-migration to our local area here for that reason that people can still buy. The average price in the Spokane market is under $300,000 here in Coeur d'Alene. It's $358,000. That is still very affordable in comparison to some of the top 20 metro markets.
Yeah, that's for sure. So let's talk about number 2. What do you think is the second reason why people are investing in these submarkets versus the bigger cities?
Well, when you look at your decision to invest your money, if you think about your investment property as if it's a business, right? depending on the legislative environment, you may have a more tenant-friendly environment, which means in the event of non-payment, you can't get access to your business, depending on this legislation, for sometimes several months.
Yeah.
Depending on the location, for instance, here in Idaho, it is more favorable to the landlord, which is why we are seeing a lot of investors be very confident on the market. That makes a big difference. If it's a difference between a 3-day pay or vacate, if you've got a tenant who doesn't pay, or even 14 days to give notice. And then, of course, in this environment, always check to see what the latest is from the mayors and the governors, because that's ever changing. But again, if you look at the underlying legislative environment, that's really important on where you decide to invest.
So here's what's interesting. Melissa has an office in Spokane, which is in Washington State.
Yes.
And then she has several in Idaho as well. When you fly into where I am right now,
Right.
you fly into Spokane, which
Correct.
is in Washington, but of course, it's right on the border.
Right.
And so what she's saying is, if you buy a fourplex in Washington and you buy a fourplex just over the border in Idaho, it could be a very different experience.
Precisely.
Right?
Precisely.
Very different.
And unfortunately, that has driven down the cap rates here in Coeur d'Alene, because so many people have been eager to get in. And that's always, like we said, not to get political about that. But again, if you're going to invest, you want to make sure you have control over that asset.
Right. So looking at right now the more landlord-friendly environments, or even just kind of what's it going to be like if you're investing in a market? What's the experience going to be like?
Correct.
From a property tax standpoint,
Yep.
from a landlord-tenant law standpoint,
Right.
from a governor standpoint,
Yes.
from a mayor standpoint, right?
Right.
Those are all
Absolutely.
things that a lot of times people really didn't consider until now, and now we're seeing it.
Right.
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 We're seeing. I mean, you see articles that say, forgive rent. Right?
Absolutely.
All over
Yeah.
the place.
Yeah.
Okay? And I'm not, obviously I'm in the rental business, so that would be bad.
Yeah.
But at the same token, I understand it.
Yeah.
People are out of work.
Right.
They're having a tough time. And so, but if you own the building and they forgive rent, then guess what? That building's going back to the bank.
Yes.
Right?
Yes. It's
because you don't get the rent, you don't pay the mortgage, and all of a
Right.
sudden now the renter is dealing with the bank.
right.
Right.
Yes.
And then you have this financial loss by the investor, et cetera, et cetera. You guys know the whole story.
Yep.
So, but those are really important things to watch.
Yep.
I have a bunch of friends that just will not invest in California. As an example.
Absolutely. And I think you've talked about how that hasn't been your primary
Yep.
market focus for that reason. It's just
Yep.
the
It could take months to
Yep.
get somebody out. Once they move in, it can take months.
Yep.
Now, I'm not saying it shouldn't or should. I'm just saying it can take months. So if you're trying to pay your mortgage and somebody's not paying you, it can take months.
Right.
That's not necessarily good if
Right.
you're an investor. And the same thing around rent control.
Yes.
That's another one.
Yes.
You guys, we were starting to see that pop up. The state of Oregon.
State of Oregon, it's fascinating that was the first state in the nation. If you go back historically, there's actually 37 states that have specific provisions that do not allow rent control. But tides have definitely changed.
They definitely have changed. The state of Oregon now has instituted rent control.
Yep.
Okay, which basically means that the government controls your rent. That's what it means. And again, when they probably looked at it from an affordability standpoint, so I understand.
Right.
But as 17, 18, 19, as rents were going up and housing prices are going up and wages were not, then of course the people spoke.
Right. Well, and I remember when that initiative came out, and I looked back on one of my rentals I had, and I've had it for 10 years. And the rent control initiative in Oregon stated you can't raise the rent more than 5%. And looking back on my rental, I saw that I only raised it about 2% a year. So with that new initiative, you better believe I'm going to be more attuned to assuring that I am ticking up that rent to fair market so that I don't have to fall under the constraints of the government.
That's right. So those are things that you need to take a look at, and that is one more reason. A lot of times these smaller submarkets, they haven't experienced all the things that are going on in the bigger cities.
Yes.
And therefore they don't have the legislation around them,
Yep.
which is why they're a little bit more, I guess landlord friendly.
Right.
Would be. So what's the third thing? And I love this one because,
Yes.
I talk a lot about it. The third thing why people invest in these smaller submarkets.
I would say cash flow. If you're looking at the rent to value ratio here in a smaller market, you're going to get more bang for your buck. So for instance, if you're going to, I've seen an example with one of my clients acquire a property for $250,000 and you can rent it for $1,700-$1,800 a month. I mean, those are really
That cash
decent.
flows.
That's cash flow.
Yeah.
I mean, that's easy numbers. So that's going to be harder to your barriers to entry in more expensive markets. It pencils.
Yeah, as I like to say, guys, it's just math.
Right. Right.
Honestly, right?
Absolutely.
I mean, because first of all, it's not easy to find rentals.
Right.
That
right.
cash flow.
Yes.
It's not. And
Yeah.
You might look at 100 and maybe find a few.
Right.
Right?
Right. Yeah.
Okay, so this is part of the process that you need to educate yourself. And so, but right out of the bat, because she's done it a lot, she knows a $250,000 place that gets $1,700 or $1,800 a month cash flows.
Yes.
But there's other reasons why it cash flows also.
Yes.
The loan and the low interest rates.
Absolutely.
The property taxes
Yep.
are low here, right?
Yep.
Also help. Utilities are lower here.
Yep. That's true.
Management costs
Yep.
are lower here, right? There's a lot of things that are lower.
All add up.
Right?
Yep.
In a lot of these smaller submarkets, right?
Absolutely.
So what are some of the things that you look at as you're evaluating, whether to buy something for cash flow or not?
When you're looking to evaluate something for cash flow, again, it's making sure you're in a market or an area that is going to be consistent. When you're looking at whether you're going to invest in a Class A, B, C, or D area, that Class A has been really strong in the last couple of years as the economy's been really strong. But making sure you're looking at a Class B neighborhood, those are going to be really solid, I think, on a forward-moving basis.
So basically, what that means is that's the core. That's where everybody is hanging out.
Clean and safe.
Clean and safe.
Yep.
Right. The Class A's are going to be expensive.
Yep.
Right. And those oftentimes people will be moving from A's to B's.
Yep.
Right. So they can afford an A, but during uncertainty they might move to B's because they're
Right.
still clean and safe.
Right.
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 Yeah. Yeah. So so let's talk just a little bit before we go. A lot of people try to time these markets and they try to. I call it the difference between cash flow and capital gains. And I'm really glad to see that one of your 3 reasons was cash flow. There are people that are coming here right now are trying to time the market, right?
Yeah. Well, and I always say you're a buyer in every market because of the one underlying thing that we haven't covered, which is a bonus reason to always buy, and that's taxes.
Right.
There's no other asset class that is so set up that you can offset your earned income in such a way that you can through real estate.
That's right. So just be super cognizant, guys. And if you're trying to become financially free, the way to do it is through cash flow. Like you did that in college at 21 years old.
Yep.
Right?
Yep. Yes.
As she started buying rental real estate.
Yeah.
Back when Rich Dad just came out.
Yep.
And everybody else is sitting there trying to find it, and she's doing it.
Right.
And you can do this, right?
Yeah. Yeah. And every year when my accountant and I sit down, whether it doesn't matter the year, I always look at that depreciation schedule and smile.
Yes,
and
of
look
course.
at how much my investments or our investments have really helped offset that tax bill.
So what she's saying is that she's got all this cash flow, but it's being offset by depreciation
Yep.
through property tax.
Correct.
Right?
Correct.
And so, by putting these depreciation schedules on all her real estate, she's actually getting tax-free income,
Correct.
right? Here's the piece that she's never talked about that everyone else looks at. How much equity do I have?
Right.
Right?
Right. That's true.
It's not that it's not important. It is important. But if you sold all your cash flowing real estate, then you would pay tax and then you would have to reinvest it again.
Exactly.
Looking for, again, cash flowing real estate.
Yep. And you
Right?
wouldn't get that write-off anymore.
Right, which is why we're long-term holders.
Correct.
And we look for cash flow as opposed to capital gains, where we're not trying to time the market and then do it again, because at some point the market stops, the music stops, and all of a sudden you're left holding the bag with having a bunch of money in something that might go down in value at some point, because real estate does go down.
Yeah.
Right?
Absolutely. And every market, you just have to look for a deal. And that's the challenge, is waiting for the market to come to you in some instances. So, just because there's a level of uncertainty right now doesn't necessarily, you can't find a deal that is 2012 prices, if you will.
Right. I can assure you one thing, guys. With all this uncertainty, just like in 2008,
Right.
there's definitely going to be more renters.
Right.
Okay.
Yeah.
So if you find something today that cash flows,
Yep.
there's not a lot of new construction.
Right.
You're going to have, again, just like in 2008, as you guys know, I bought
Right.
a whole bunch of rental property during that time frame. A lot of people moved out of houses into rentals, and they're going to have to do that again because of this. When forbearance ends,
Yep.
you're going to have people that are going to have to make that shift
Yep.
because they might not be certain about their jobs or their income or their futures, et cetera, and they're going to downsize.
Yep.
Right?
Very true.
Right? So just know, invest for cash flow and not for capital gain.
Yep.
Awesome, Melissa. Thank you.
Thank you.
As always, I appreciate your time. You guys, thank you for the great questions. The 3 reasons to invest in submarkets versus bigger cities. I think this trend is here to stay. What do you think?
I agree. I think we're going to look back and wonder. I think the face of the urban cities won't look the same for a while.
For a long time. Yep. Thanks.
Thank you.